I am Jennifer Hogenkamp. I'm a partner at Citron Cooperman. I also have Dan Sweditz. He is a manager at Citron Cooperman who's going to help me out as well. So we'll jump right in, and feel free if you have any questions. There's a Q&A box up in the control panel. Feel free to put in any questions, and at the end of the presentation, we can go through any questions you have. We're also available. I think the slide deck will have our, I think the next slide will have our contact information. So feel free to reach out. We've done these implementations several times now. So they can be painful, especially we'll get into it if you have a lot of leases, but kind of an overview. So years and years ago, when Enron hit and everything else changed in the accounting world, there was this issue with a lot of off-balance sheet liabilities that were still kind of hanging out there. And I think this adoption of this new pronouncement is kind of trying to put a lot of those liabilities back on balance sheets. So basically what happened is that they figured out that there's about $3 billion worth of off-balance sheet liabilities that were hanging around out there, some of which are operating leases. Capital leases, for the most part, were always on the balance sheet, but operating leases were not. And you just found them kind of in the financial statements back in the footnotes. So what they're trying to do with this is put all of those leases on the balance sheet, so now they're a little bit more transparent to the readers of the financial statements and not buried in the footnotes in the back. So the public companies went through this about 3 years ago. So they started in 2019 in interim periods within there, and maybe even earlier if they were doing it under the modified retrospective method, which showed the comparative periods year over year. And then private companies kept getting, because of COVID, because of how actually costly it was to implement this, it's been about 3 years later now, and it kept getting deferred and deferred. So now it's time for private companies to do it. It's effective for beginning after December 15th, 21. So basically year end 12/31/22, and any of the interim periods in between. So if it's actually effective 1/1/22 for calendar years, and then also if you're doing quarterly reporting, it's something to think about because technically you're adopting as a 1/1/22. So as I mentioned, there's two transition methods. You can either do it comparatively, which is the modified retrospective method, or you can do a cumulative catch up in earnings. And that is just basically in the year that you adopt. If there's any retrospective adjustments that need to be made, they can do a cumulative catch up right through earnings for those. So just quickly, some thoughts on the transition. Like I said, we have gone through this years ago. It was deferred for a while for the private companies, but what we saw was it was a big expense and a big time. It was a lot of time that was spent pulling together and trying to inventory and gather all the lease documents, especially if you are multi-location. So if you are a company that has entities all over the place, or has multiple legal departments, multiple finance teams, it becomes a little bit tough trying to gather all the documents and where they reside to try and put together all of the numbers to kind of transition effectively. So it's a costly process. Like I said, it's time sensitive. So gathering the data, if you haven't started, and you have a lot of leases all over the place, the time is to start is probably soon, because once you gather all the documents, you have to read through them all, collect them and log them. So a lot of companies, the operations and the finance teams and the legal teams, they're all pretty separate. And sometimes they aren't the best at communication. So sometimes the actual signed agreements are with the legal department, and finance sometimes isn't aware of them. It's really getting those policies and procedures in place. So if new leases are signed, they are coming to the right people in finance, whoever's going to collect and do the spreadsheets and take care of that. There's multiple ways to do this. If you're a company that has only maybe a couple leases, you can really just track them potentially in Excel. We worked with companies that had hundreds of leases, and it's probably best if you don't already have a system to do it, There's many that are out there, especially since 842, ASC 842, which is what this is, has popped up. So there, we've looked at quite a few of them. We've tested some of them, but you know, a larger software package is probably helpful because there's so many nuances to this standard. We're going to get into the high level of this, but there are, you know, if there's modifications, if there's changes in rates, if there's extension options, anything that happens, you really need to adjust the numbers. And, you know, it's a little bit difficult and a little harder to do in Excel. But like I said, it all depends on how many leases you have. So very important to start this process now, especially if you're doing it for this year end. One of the biggest things, and we'll get into this in a little bit, is you know, also thinking of maybe discussing this with the banks, and we'll tell you why. So one of the things that also changed is the definition of a lease. And capital leases were always on the balance sheet, but for GAAP purposes and for 842 purposes, now they've defined a contract as a contract or part of a contract that conveys the right to use identified property. And that identified property, here it says plant or equipment, an identified asset for a period of time in exchange for consideration. So it does not include intangible assets. It doesn't include inventory, assets under construction. They say, you know, it doesn't include like minerals or oils or gas, but mainly what we see is buildings, equipment, land leases. There's all different kinds of, you know, PP&E leases. It also does include subleases. So subleases are embedded in this. We're not going to get into that much today, but subleases are also part of this guidance. So there's 5 criteria. There were 4 criteria before to determine how to classify the lease. So in the past, with the capital lease, there were 4 criteria. Ownership of the underlying asset transfers at the end of the lease term. If that's there, it's a finance lease. An option exists so you could purchase, and it's reasonably certain that you will purchase the asset at the end. The lease term makes up a major part of the asset's remaining economic useful life. So if the life is, 10 years and you're using 9 of it, it's probably made what they call a major part of it. And that would also be a capital lease or finance lease, sorry. And the sum of the present value of the lease payments is equal to or exceeds substantially all of the underlying asset's fair value. For the most part, they've said that substantially all might be about 90%. In the past, it was a little bit less. It's defined in different places, but if you're using, the present value of those lease payments makes a majority of the fair value, you probably have a finance lease. The newest one, which is number 5 here, is the underlying asset's specialized nature. So if somebody's building an asset for customized use, that is also going to classify as a finance lease, and it doesn't have an alternative use at the end. So if somebody's, like I said, constructing something, an asset for you or for the company, it will probably fall as a finance lease. And otherwise, if it's not any of these 5 criteria, it's going to classify as an operating lease. Now, one of the things that I also wanted to touch on very quickly is on a lease, if you have the right to direct the use of the asset, the right to the economic benefit of the asset, and to operate without the supplier having change rights, there's a lot of things that qualify as a lease that may not have before. So sometimes contracts aren't called a lease contract, but there might be a lease embedded in it. There's examples if there's fiber optic wire and a company has, there's 10 of them in a bundle and the company's using 3 of them and it's dedicated for them in a specific company, and it's because it's a tangible asset, that could qualify as a lease. So there's a lot of things that could be embedded now. And that's why when we talk about it, kind of going back and re-reviewing leases, you could find contracts that have embedded leases that you weren't aware of before. So all contracts that, where there's a right of use of an asset should be reviewed to see if it falls into the lease guidance. So just quickly, this is similar to what I was talking about before. So existing GAAP was on the balance sheet. They're classified as capital or operating leases. Capital leases we've had forever. They recognized capital leases were on the balance sheet and, the assets and liabilities were disclosed in the footnotes. They're now called finance leases. So if you see the terms, they're pretty interchangeable, but most of the guidance now says calls it a finance lease. And so capital leases, finance leases remain the same. Most of the accounting for them is remaining the same. The operating leases now, all operating leases are going to be on the balance sheet. So we'll get into the accounting for that in a second. But almost every lease now, and that's the biggest thing with 842, is putting them all on the balance sheet. The one big thing this will trigger, which is, which we show on the bottom, is the impact that it's going to have on certain ratios. And for covenant compliance with the banks, this is a pretty important factor in this, is to take a look now. We'll go through a couple of examples in a few minutes, but there are going to be definitely some covenants that are going to be impacted by the adoption of this. So working with the banks now, or your bankers now, to get an understanding of if it will comply, what you should do, if you should wait to get a waiver, if you should kind of do an amendment to your current agreements. If it does have an impact, it's not something you want to wait till the end, at 12/31 to be saying, oh, we should take a look at this now. It's probably something to get ahead of now, because like I said, it could make you not, or fail, your covenants. So how is a lease recorded? So a capital lease, finance lease, like I said before, it's on the balance sheet. These are the ones that we've always had, same as before, but it's now going to be a right of use asset and lease liability, present value of the minimum lease payments on the balance sheet. In the income statement, you're still going to have an interest component and an amortization of the right of use asset. And then, so that will be, depreciation expense. A lot of times these are lumped in with fixed assets and, specifically broken out in the back in the footnotes. So that can continue to be that way, or you can specifically highlight them as right of use assets for finance leases on the balance sheet. The cash flows remain the same for capital leases. For operating leases, now we're going to, like we said before, going to have the right of use asset lease liability, which was never there before, on the balance sheet. The difference is operating leases were always recorded on a straight line basis over the term of the lease. So you would take the total lease expense and you would kind of amortize it or straight line it so that you had a consistent flow across years on your lease expense. That will continue that way, but you're going to have two separate components, which we'll get into, I believe, on the next slide, which is going to, next couple of slides, which is going to have an interest component and kind of an amortization piece that's going to flow into lease expense, which will get you at the same point you were before. And all of the cash flow payments are going to be categorized on the statement of cash flows and operating activities, whereas, as we saw on the prior slide, they're different. So that the capital leases, the lease payments will be in operating, the lease liability, principal portion of lease liabilities and financing, and the interest on the lease liability in operating. And this is just a better overview of kind of what it's going to look like. As you can see on the balance sheet, operating leases are going to go on the balance sheet, but they're both, for financing and operating, going to be the right of use asset and lease liability. On the income statement, you have the amortization expense and your interest expense for a finance lease, same as before. And then on the operating lease, it's going to be a single lease expense on a straight line basis. Dan will show you how that's going to work in a couple slides. But the balance sheet presentation, one thing it will change. So the way that currently, obviously, because the operating leases are not on the balance sheet, you can't combine, so you can't put operating leases and finance leases together on the same line. So you could potentially, especially on the liability side, have a current and long-term portion of the lease liability, both for finance and operating. So you could actually have 4 new lines, depending on materiality, but you cannot combine the operating and financing in the same category on the balance sheet. And then in the income statement presentation, you're going to have the lease expense from operating, and then similar to what we had for the capital leases before. So quickly, how is the lease liability and asset actually measured? So the lease liability is taking into account the fixed payments over the life of the lease. If you intend on exercising an option to purchase the underlying asset, you would include that. You would include if extension options, if you believe that they're going to go out. So if you have a 5-year lease with 2 5-year extensions, if you believe those are going to be exercised and you're actually going to use those, you would actually include that. Variable lease payments that depend on an index or a rate are measured at the rate at lease commencement. And then any changes to that rate over time would just flow to the P&L when the payment's made in the year that it's made. But you would not go back and adjust the lease liability. The discount rate has been a big topic, especially for private companies. So you can use the rate that's implicit in the lease. So if it actually says it, a lot of leases actually don't say what the rate is. If it's not readily determinable, you could use the incremental borrowing rate for the company. But the private company councils also come out and said you could use the risk-free rate as well. The trouble with the risk-free rate is the rate is typically a lot lower. So it's going to increase your liability on the balance sheet. If it doesn't matter, because you're just really, putting the asset and the liability on, that's fine. But the determination of the rate is also something you have to take a look at, obviously, to determine the present value of the lease payments. So on the ready-use asset, it's the same thing as the lease liability. So basically, you take the lease liability, as we described on the previous slide, and then you make adjustments to it. So if there's any initial direct costs, if there was any commissions paid, any incentive payments, any prepayments. So you would, as you can see on the last line here, you take the lease liability, you're going to add any initial direct costs, back out any lease incentives and prepayments. This does not include, so you wouldn't include in initial direct costs any legal or overhead. Those are typically expensed as incurred, but these would be costs that would not have been incurred, as you see here. So any initial direct costs incurred costs are those at the end you would not have incurred if the lease had not been entered into. Like I said, legal costs are not considered. So lease liability and then putting on the lease asset, and the lease asset, like I said, is we'll get into how that amortizes. But getting the lease liability is kind of step one, and then you adjust to get to the asset. So items to note, there's a couple of things here just as we're implementing it for some companies, and some things to take a look at. Like I said, extension periods that have a reasonable chance of being executed should be included. There are a lot of leases that have extension terms, but you'd only include them, like I said, if you expected them to be included or exercised, I'm sorry. Lease modifications, sometimes they could result in new leases or, having to remeasure existing leases. So always be aware. This gets back into the first couple slides where we were talking about how to, hold on to the leases, know when they're modified, have a good policy and procedure in place, because this will affect the numbers if there are modifications that are made to the leases. Another thing, sometimes these embedded leases, there could be other components. So there's, you could have a bigger agreement that has non-lease components like CAM or taxes or insurance, or other components that are non-lease components. So you have to kind of take a look, break out the payments related to the non-lease components. There is a practical expedient we'll get into where that you can take an exception to this when you adopt. That will allow you to either combine them all or do it a little bit simpler. Lessor accounting on the lessor side is relatively unchanged by this. Sometimes it follows 606 instead of 842, but a lot of the lessor accounting, you gotta kind of have to take a look at it, but it remains relatively unchanged. One big area that I think a lot of smaller private companies deal with is related party leases. So we wanted to touch on this a little bit. Related party leases a lot of the times don't have contracts in place. There's not a lot of contractual terms. So it's really getting an understanding. If you have a lease in place and it's an operating lease and it's for buildings or it's with a related party, you may need to potentially have one written or modified. One of the issues we see a lot of the times, which is this last bullet point, is that a company has a related party lease for a building. They're putting on leasehold improvements. They're making, they're repaving the driveway. They're doing all kinds of things. And then they put those on for 20 years. Well, it's really hard to say that your company's in a month-to-month lease and therefore not following 842 and not having to capitalize it because there's no long-term lease. But then you're capitalizing leasehold improvements for 20 years because of, you're expecting to stay. So it's one thing that could trip you up. So make sure, whether it's company that's listening or, bankers, anyone, that if the leasehold improvements are showing that, it's a long-term lease, it's probably going to have to follow 842 and be capitalized. So just one thing to take a look at. We do see that quite often. I'm going to turn it over to Dan now to go into some examples of, an operating lease, a finance lease, and feel free to ask any questions.
Thank you, Jen. So to cover the facts for our example, it's a 3-year lease term. The payment schedule is an escalating lease with the $200,000 in first year, $300,000 in the second, $400,000 in the third year. The discount rate is 5%. So that would be how Jen mentioned, either using like an implicit rate in the lease or the risk-free rate. So we're using 5% here. The present value of lease payments is discounted at that 5% is going to be the $808,000. We're going to be looking at this as both a finance or an operating lease. So in the case of an operating lease, the straight line annual payment is $300,000. There are no variable lease payments to be considered, whether we look at this as financing or operating in this example. So if you want to go to the next slide, Jen. So first, we're going to take a look at it as a finance lease example. So as you can see on here, the initial, the present value of the lease payments is going to be what you put on for both your right of use asset and the lease liability, that $808,000. So for the right of use asset over the term of the lease, you're going to straight line amortize the right of use asset. So the 808 divided by 3 gives you the 269, and that's the amortization expense of the right of use asset over 3 years. Same thing each year. The lease liability has a little bit more to it. So you have the 808,000. The payment, the lease payment is going to be based on how it goes each year. So 200,000, 300,000, 400,000. But the change in the liability will be the actual cash paid less the interest expense. So this case, the interest is 5%. So 808,000 times that 5% rate is the 40,000 in the first year. So $40,000 will go to interest expense, and then the remaining 159 will be what decreases the lease liability in that first year. And you do similar treatments in each one of the 2 subsequent years for finance lease. If you want to go to the next slide, Jen. So just to give a summary to see how both the P&L effect is and the operating cash flows. So we can see the interest expense year over year is going to decrease just like it would with any normal liability, because now we're treating this lease as the finance lease. Amortization expense is straight lined over the 3-year term. And you'll see that the total expense will decrease over the term of the lease as the liability decreases and the interest decreases. Because of the breakout with the finance lease between interest expense and amortization, it will have affect different parts of the cash flow statement. So the interest piece would be going up in the operating cash flow section. So each year, the interest expense piece will decrease in the operating cash flows, and the financing piece will be increasing as you're amortizing more and more of the liability as each year goes by. But overall, the total cash flow for each year would go in line with what the actual lease payments are on the lease. Next slide, Jen. So now looking at the operating lease example, this is where more of the changes come into play, whereas on the finance lease, it's pretty comparable to how we currently treat capital leases. Operating is going to be a little bit different. So now we have to do these right of use assets and the lease liability, as Jen has mentioned. The initial entry to be putting on the operating lease is exactly the same as the finance lease. So day one, same exact thing, $808,000 for the right of use asset, $808,000 for the lease liability. Now, how those two change over time is where the differences come in between an operating lease and a finance lease. So on the right of use asset, the total expense on an operating lease is straight line. So the interest expense piece and the amortization expense. So the right of use asset is not going to be straight line amortized. It's going to be the actual straight line expense less the interest piece. So in this case, the straight line expense is $300,000. The interest piece, just like on the financing lease, is the $40,000. And then the remaining amortization on the right of use asset is $260,000. So as the interest expense decreases year over year, the amortization will go up, keeping the total expense at $300,000, straight lining it, the actual expense over the term. The lease liability, however, is treated exactly the same as the finance lease, where it's just the actual payment less the interest expense is where your change the lease liability on each year will go. So as the interest expense goes down, more is coming off the lease liability each year. Just a couple things to note. With the above illustration, the calculation for subsequent measurement of the return of use asset, and it depicts the calculations necessary for the subsequent measurement of the right of use asset and lease liability. And interest and amortization. So on here, we break it out between the interest and amortization. That's how you calculate what the two pieces are, because the interest is still related to the lease liability. But when you actually look at the income, the statement of income, statement of operations, it'll go into one line item that'll be called something like rent expense or something like that, similar to how operating leases are currently done. So on a finance lease, you have the interest and amortization as two separate line items where that expense goes to, whereas with the operating lease, it's all going to go as one rent line, and that would be above the line, similar to how operating leases are currently done. Jen, if you can go. So just to summarize it again, so here you have the interest, you can see the interest expense, how it decreases each year, amortization is increasing, total expense $300,000 every year, so the expense is still straight lined. As I mentioned, we break it out here between interest and amortization, but it would just be one line rent expense above the line in your statement of operations. And then your, as far as the cash flow goes, because it's an operating lease, all of this goes into operating cash flow. So the finance lease could actually cause a higher operating cash flow compared to a finance lease could cause a higher operating cash flow compared to the operating lease, due to all of the expense being part of operating cash flow on the operating lease. Okay, Jen. So just the sample journal entry. So here would be the recording a payment in the current year. So you've paid $200,000 in the first year. You've recognized $300,000 of rent expense. Your right of use asset goes down by that $259,000 of amortization. And your lease liability is that $159,000, which is the difference between the interest expense and the actual cash paid. Okay, Jen, next slide. So just looking at it on a balance sheet now, you can see Jen had mentioned on the presentation, there are the multiple instances, the multiple line items here. So this is specifically for the operating lease, where now you're going to see the right of use asset as a non-current asset on here, that $808,000, that first blue line. And then you also are going to be showing both the current and long-term pieces of the lease liability, that second and third one. So this is just showing the operating lease piece. In the instance that you have both operating and finance leases, you would show them separately, whether it's on the face or you're noting it in the footnotes, depending on where you put the finance lease. You have to keep the operating and finance leases separate. You can also see here how, now that you have to put the leases on the balance sheet, how it's affecting things like the current ratio, the debt to equity, and the net working capital. Now the current ratio, due to the non-current asset, right of use asset being put in addition to the current portion of a lease liability, it brings down your current ratio. Debt to equity, now you're putting more liability on the books, which under the old rules for operating leases wasn't there. So now that debt to equity is going down. It brings the net working capital down. So you can see just how this the operating lease is going to substantially change how the balance sheet looks. So as Jen had mentioned, it's just something to keep in mind when you have debt to equity ratio requirements and things like that in debt covenants. Next slide, Jen. So the previous slide was using the same numbers from our examples. This is just to give another view of it where you could just see how the ratios are being done. So on here, you have that right of use asset of $1 million. That's going to be on there. Before it wouldn't have been. Now you also have the current portion of lease liability, $200,000, and the the long-term lease liability of 902. So here again, you can just see that before you had a debt to equity ratio of 0.7. Now it's going down to one, changing to 1.4 because of the inclusion of the additional liabilities. And with the current ratio, the decrease in the current ratio related to the right of use asset being strictly a non-current asset, whereas you have both current and long-term pieces of the lease liability.
Thanks, Dan. So I'll hop back in and we'll finish this up. There's a couple other slides that we want to go through and some other items to touch upon. So, now that Dan's gone through that and we've kind of touched upon how the accounting for it goes, there are some items that you can adopt when you initially adopt 842 that helps and makes things a little bit more streamlined and easier to adopt. So the first one is a package that you can adopt together, these first three. So in the initial adoption, you can elect to not reassess lease classification. Sometimes when you're relooking at it based on the new guidance, whether it was an operating or a capital lease, it's, reassessing that. You don't need to reevaluate whether a lease continues to be a lease under the new guidance. Also, indirect costs, direct costs, if they met under 840 and continue to be met under 842, you don't have to reassess those. So if you adopt this whole package, which most people did and are going to do, makes it a little bit easier. Some other practical expedients, if you have a lot of leases where there's a lot of multiple components or non-lease components, you could combine them and not separate them. The only issue is you're now capitalizing a liability or a portion of that lease payment that might not be related to a lease liability, but it might save a lot of time and energy trying to figure out, the different components. We talked about this quickly. You can use a risk-free rate as your incremental borrowing rate. That's another practical expedient to adopt. You can adopt to not recognize leases that are shorter than 12 months. So on the date of adoption, at least at lease inception, the short-term leases can be left off. And the use of hindsight. And hindsight really is, now looking back, were renewal options entered into, were there purchase options that were taken, were there potentially impairment of assets or impairment of the leases? So that's one thing with 842, now that you're capitalizing more assets, so are there any impairments to those assets will also have to be looked at. And there's one last one that's not on here. It's similar, but you can also use a discount rate. So similar to using the bullet with a risk-free rate. If you have a portfolio of assets that have multiple or similar qualities, you can use a portfolio approach and put a discount rate and use the same one on all of those. So these are what we call practical expedients. You'll see them adopted or not adopted, but it will be in the footnotes because it will help to determine how the accounting for these is, and you can adopt or not adopt, like I said, all of these except for the top three, which have to be done as a package. Here's some changes. This is going to be probably the largest portion of it, is aside from the ones that the line items on the balance sheet, there's going to be a lot of disclosure requirements. So there's going to be both qualitative and quantitative. You're going to have to talk about how you determine the leases, the determination of the discount rate. There's a lot more. They're really beefing up the disclosures surrounding both the capital and finance leases and the operating leases. So, weighted average remaining lease term, weighted average discount rates, cash payments, subleases, if there's any. And then all those practical expedients, just like I went through a minute ago, you have to, lay out which ones you're adopting upon initial adoption and which ones you're using and which ones you're excluding. So you can see this is a pretty lengthy disclosure requirement list, but it's, it's just providing, like I said, a lot more to the readers of the financial statements on items that weren't really there before and didn't have as much surrounding them in the financials. Some good news, in the best case scenario with sale leaseback transactions in the past, a lot of times they were accounted for as a financing arrangement. You weren't able to get that gain on sale component because it was deferred, but with the new standard, the full gain is recognized on the sale in the year sold. So as long as you meet the 3 criteria that are listed here, control of the leaseback property transfers to the buyer under 606, the leaseback is an operating lease, so the lessee is recording it as an operating lease, and there's no repurchase option in most cases. So if you have that, you can now recognize that gain on sale in the year it's sold. So just to touch back and to kind of circle back before we close, the next steps, I think one thing that's not on this slide is talk to your banks or the bankers talk to clients that might have issues with adding some of these, especially multi-location, large companies that have many, many leases or have manufacturers with a lot of equipment leases. That's something to take a look at and see if any of the covenants are going to be tripped up with the implementation of this new standard. Then, for companies that have a lot of leases, it's just starting to find somebody who's actually going to be in charge of this project, because it is a project. And, understanding what leases you have, are there leases embedded in other leases, taking a look and figuring out what software you're going to use. And then on top of that, what metrics? So, are there extension options? Are you going to use those? What borrowing rates? Are they embedded in the lease, or are you going to have to use the risk-free rate? And the package of practical expedients, which ones you may adopt and which ones not, so that you can really start to pull together all of this documentation. It is a large task if you wait until the last minute, and this is required for your financial statements. It's a lot of work. It's not as simple as it seems. If you have a couple, it might be simple, but for those companies that have a lot of leases, it's really something you want to start taking a look at now and not wait till year end, especially if you have quarterly reporting. So really, really emphasize that this is something that's important. It's no longer going to be deferred. We hope not, because it's been deferred so many times. Actually, they can defer it forever, but it's coming to a theater near you. So you want to really take the steps necessary to be in good shape for year end. So like I said, we've done this for a lot of clients. We did it. We helped some public companies implement. We've been training and reviewing this for years now, because it was deferred, but now it's here. So, if you're a company that has a lot of leases, needs help with just understanding, policies and procedures, gathering the documents, which tools to use, or just having an overall conversation, we can help in any way. We can, help discuss with the lenders and any changes that potentially need to be made to the loan agreements. But we've got a lot of, we've had a lot of questions. We've had, some consulting arrangements where we've helped out a lot of companies implement this. So we are here to help. You have our contact information that's right at the beginning of the slide deck. More than welcome to get a copy of the slide deck. And thanks for attending, and feel free to ask any questions if you have any. Thank you. Have a great afternoon.